Here we are. Time to talk money nutrition. I'm Zach and I'm your nutritionist for the day. Let's talk about bonds. Some people don't want to deal with the ups and downs of the stock market. They want something that's going to give them a stable return. It's fixed. They don't have to worry about it. It's especially essential if you're older. You don't want to worry about the stock market crashing because you need money for retirement, and that's where bonds come into play. Bonds are called fixed income securities. An example would be a corporate bond because the corporation needs a loan from people at a fixed interest rate. So they're going to pay you an interest rate every 6 months, and they promise that in the end, they'll pay you back your principal with the last interest payment. So you essentially become a bank. Now there's all types of other bonds. There's corporate bonds, I bonds, municipal bonds, Brady bonds, foreign bonds. But the concept is that they're meant to be fixed income securities, so you know what the returns are going to be. Bonds are also liquid, which means if you need the cash, you can liquidate them fairly easily, depending on the type of bond you have. But there are risks involved. For instance, will the business that you just lent money to be in business over time? There's also call risk, that they might buy the bond back before you ever get to reap much of the interest on it in the first place. And then if you essentially get money back from your bond, you have to reinvest that if you don't want to pay taxes on it. So there's risks involved when it comes to buying bonds. But if you want something that's a little more stable than common stocks, that's what you can turn to. And this has been your Minute of Nutrition for today.